Welcome to this explainer. Okay, so if you're a Canadian business owner, you already know that scaling your operations is thrilling. But yeah, it comes with a massive, very expensive catch. You need heavy-duty machinery, commercial vehicles, or specialized tech to take that next big step, but you absolutely cannot afford to drain your bank account to get it. Today, we're breaking down the ultimate guide to equipment financing, giving you the tools to acquire the assets you need to grow, all while protecting the absolute lifeblood of your business, your cash flow.
It's the ultimate business catch-22, right? You literally need that equipment to generate more revenue, but paying for it upfront leaves you dangerously low on the cash you need to actually run your day-to-day operations. So how do we bridge that gap? How do you keep the money in your pocket while still putting that new excavator, commercial truck, or medical device to work?
So here's our roadmap for today. We're going to look at the equipment funding dilemma, whether to buy or to lease, explore some lease structures, take a peek inside our real agreement, and finally, go over the steps to secure your funding. Let's dive right in. All right, Section 1, the equipment funding dilemma and protecting your cash flow.
Look, whenever your business needs expensive machinery, every single new purchase represents a giant hurdle. Tying up your capital makes it incredibly tough to jump on new opportunities or even just cover your monthly expenses. So before you even glance at a catalog, the Business Development Bank of Canada, or BDC, really urges you to ask yourself a few strategic questions. Exactly how much can you comfortably afford to spend? How stable is your working capital right now? Do you actually have the internal capacity to maintain and repair this equipment yourself? And realistically, what is this equipment's expected lifespan before it becomes obsolete? Your answers to these questions are going to dictate your entire strategy.
Moving to Section 2, to buy or to lease, the core debate.
It's the classic trade-off. Buying? Well, that means lower overall lifetime costs and total ownership, giving you the complete flexibility to alter or sell the machinery whenever you want. But leasing? Leasing acts like a shield for your cash reserves. It requires way less cash up front, and it gives you a sort of VIP pass to continuously upgrade to cutting-edge gear without the harsh sting of depreciation.
The BDC actually hits the nail on the head here. They state, in most cases, it's cheaper to buy up front than leasing to own. But if you're in an unstable or fast-growing business, leasing may put less strain on your cash flow. So, why does this matter to us? Because if you're scaling rapidly, tying up your cash in a depreciating asset might literally choke your growth.
Okay, Section 3, exploring lease structures. Let's define your arsenal. First up, we've got the classic term loan. Say you go to a local development corp like Economic Partners. They might offer up to $150,000 with a max 10-year amortization period. The catch here is that it requires collateral security, and honestly, you usually have to exhaust your other traditional financing sources first.
Next up is lease to own. This one is a super cost-effective way to get the gear you need to deliver high-quality service right now without dropping heavy upfront capital. You just make specific predetermined payments over a set term with the full intention of buying the asset for a residual amount at the very end.
Now, the sale-leaseback. This is honestly a brilliant financial maneuver. You'd be surprised how many businesses are just sitting on trapped equity. If you own your equipment outright but you're desperately short on working capital, you can actually sell your equipment to a lender to pull that equity out as cash and then immediately lease it right back from them. It is an absolute lifesaver when you don't have a proper bank line of credit. And finally, the residual lease. This is a perfect example of how to conserve cash flow. The payments are literally custom-tailored to match the exact revenue stream the machine generates. Then, at the end of the term, you're left with a residual amount that's pretty close to the wholesale value. It's incredibly popular for businesses that want to easily trade up to brand new equipment when the lease ends.
All right, Section 4, inside a real agreement, the Castleman case study.
So, let's ground this abstract theory in reality. We're looking at a formal equipment rental agreement executed between KB Media Corp as the lessor and the Village of Castleman as the lessee. They are entering an agreement for an outdoor electronic message setter. Let's peek under the hood and look at the actual numbers they agreed to. So, the approximate total value of this Galaxy outdoor electronic message center? $26,500. Unless your municipality found a hidden treasure chest, that is a massive upfront capital expense to just buy outright. But instead, check out this much smaller, crucial number, $2,825. That's the initial rent, inclusive of HST, due before they even take possession. By going the leasing route, the lessee dodges a massive financial hit.
They protect their immediate working capital while still getting the equipment delivered and operational.
And right here is where we see that lease-to-own or residual concept in action. The contract clearly states a residual value of $24,000. So, at the end of the 4-year term, the lessee has the option to outright purchase the equipment by paying this exact specific amount.
But you know, a lease is way more than just numbers. It's entirely about allocating risk. The lessee takes on the risk for loss, theft, or damage, and they absolutely have to maintain full replacement insurance. But check this out. In a really interesting twist, customized for this specific deal, the lessor actually took on 100% responsibility for the operation and maintenance of the digital sign. It's just a brilliant example of how these contracts balance risk and operational responsibility.
Okay, Section 5, Steps to Secure Funding. Here is your action plan.
Firms like Money in Motion and Premier Equipment Financing have honestly narrowed this down to a science. Step 1, you just tell them about yourself in a quick online application. Step 2, you speak with an industry expert to tailor your structure. Step 3, submit your basic business documentation. Step 4, and this is definitely the best part, you generally receive an approval within a rapid 24 to 48 hours. And Step 5, you get the equipment, expand those operations, and start making a profit.
Which leaves us with one final, pretty exciting question for you to consider. What will your next big business move be? Now that you know upfront capital doesn't actually have to be an obstacle. Because whether you choose to buy, lease to own, or pull off a sale-leaseback, the tools are absolutely out there to fuel your growth while keeping your cash flow completely secure. Thanks so much for joining me for this explainer, and hey, here's to your business's success.